Hello, Harold Hagen, Verico My Mortgage. As many of you who follow the markets probably already know, for the first time in recorded economic history, the entire yield curve is trading below 1%. The 5, 10, and 30-year bonds are trading below 100 basis points. And as you may know already, the Bank of Canada lowered its overnight lending rate by 50 basis points or half a percentage point just last week, a move not seen since 2015. Actually, Stephen Pulitz, the Bank of Canada Governor General, just announced this afternoon that he dropped interest rates again by another 50 basis points. That's a full percentage point in a week. This signals that the market is very concerned about a global recession and aggressive monetary easing by federal governments. Monetary policy can help markets temporarily, but unfortunately, it can't put people back to work or fix supply chains. But I think it's important to understand this. Despite the troubling signs in the Canadian economy, money is still flowing. Unlike the financial crisis back in 2007, 2008, there is no liquidity crisis today, yet. Liquidity is access to capital. The only crisis currently is confidence with respect to economic growth. And this makes this situation significantly different than back in the Great Recession. At this stage, it's difficult to predict how Canada's banks will respond to further rate cuts by the Bank of Canada. It's also important to understand that banks don't always necessarily pass on the full savings or the full reduction in rate decreases. With respect to home financing, that directly benefited variable rate mortgage holders and home equity lines of credit. As a result, the additional household cash flow resulting from lower personal and mortgage debt could add some resiliency to the economy. If you have questions about how these rate drops affect your mortgage and your household budget, reach out and let's have a conversation. Harold Hagen, Verico My Mortgage.